So much has been happening in the property market over the last couple of years. I wanted to give you an update, and in today's video I'm going to be breaking down what's happened over the last couple of months, what it means for you and your property investment journey. So specifically, let's break down October and what's been running up until now in property. So let's start with price. It has gone absolutely crazy over the last 12 months, where we've experienced 10.6% growth. That's over the last 12 months. That was terrible, which is insane. Bear in mind, the long-term average is 7.9%, which is very high in general. And really, we're aiming for areas with 5%. So it's over double that. And that's across the UK, with some areas with over 13% in the northern areas of the UK right now. Even in the last month, there's been a 1.8% increase in that price. And a lot of that is due to demand. So obviously demand in property has gone insane, but actually when we say insane, what do we mean? Well, year on year growth, we're looking at over 65% year on year. 65% more properties have been sold last month compared to 12 months ago. Now, there's an element of the fact that was it suppressed slightly last year? Yes, a little bit, but actually when we're talking about this growth, we haven't seen that sort of growth since October 2015. So this is amazing sort of growth that we've seen over the last 5 or 6 years. Is it going to start settling down though? There's a few different things that have been boiling in the background, and that is stamp duty, B-bills, and of course, furlough. Why are these three things linked together? Well, everything around this is going to suppress the growth. Why is it going to suppress it? Well, what's been happening, you may have noticed if you're already in the property game, is solicitors have been prioritizing cases that were likely to complete last month. And the reason for this is the stamp duty rush, i.e. the government has given an allowance this year to make sure that we are incentivizing people to buy properties. That is great and it works. The problem with it is when that came to an end this month, everyone was rushing to get the properties through. So you see this massive surge, which is contributing towards this figure here and all of these increases, and then suddenly it relaxes a bit. Now, does this mean it's a turn and it's declining massively? No, you just need to factor in that if you're looking at a growth pattern, expect something like this to go. And it doesn't mean there's some sudden depression here. It's because of that pent up release, if you like, that has come from the stamp duty exemptions coming in. Then, of course, you've got B-bills. Well, what is that? B-bills and C-bills has been the government contribution to business owners like yourself, like me, that has really helped a lot of us push along over the last couple of years. Now, that's been great, but payment time is due, okay? And a lot of people that had £200,000 turnover businesses took 50 grand from the government, and now they're having to start to pay that back. Fortunately, they have allowed the spread over 10 years and ridiculously low interest rates, or free for a lot of people. And so, but those payments still, 800 quid a month, whatever it comes in at, that's actually quite painful. Finally, furlough has come to an end, right? And this furlough is actually really important to the overall economy. If you've noticed, a lot of other countries, their unemployment rates have been skyrocketing, whereas us, really, it's increased, but only to 4.8%. I think a lot of businesses have kept employees on because of furlough. Obviously, Jamie, but what I'm really worried about is, has the world or the country opened up enough for those jobs to be relevant in a lot of businesses? I think a lot of business owners have realized that actually there's a lot of their team that maybe they got a bit bloated over time. Maybe they didn't need certain team members. They've realized that actually a lot of the team have stepped up during this period. And I think over the next 3 months, maybe to 6 months, we're going to see quite a lot of people let go. Now, will that have a dramatic impact on home ownership? I'm not too sure it will, but I'll get to that in a moment. But it is something we need to be thinking about with the risk assessment that we need to be going through. Another thing over the last couple of years is the government has been printing money like it's going out of fashion. This is also known as quantitative easing, and everyone loves quantitative easing, right? Well, no, actually, quantitative easing is overall a pretty stupid thing to be doing. America has really taken the mick with that, but we've not been too far behind. The problem with this is it needs to be paid back. Just a quick lesson on that. The country creates money out of nowhere and then allows people to buy debt, bonds, which allows the government to give out money to us. It's all rather trivial in the grand scheme of things, but money created out of nowhere, you can borrow it, but now you need to pay us back so we can get rid of it. Great. Good thinking there. But what actually happens with this is two things. Number one, inflation, which by the way is awful for day to day, but as a property owner is brilliant, because if there's inflation on everything, it drives prices up, including the price of bricks and mortar. And so for people that are contributing in the new build sector and developing property, prices go up massively for them. What does that mean? They have to charge high, they have to charge higher prices. What does that do for the existing stock? Well, it makes it better price-wise for people, and so naturally more demand, and that drives up prices. Small economics lesson for microeconomics for you there. Not that I'm geeky at all. So, and then finally, we have got the interest rates, which we have been enjoying for the last 5 years, but is about to go up, predicting that in the next couple of weeks. I think it won't be too dramatic. I think it'll be about 25 basis points, which is going to be 2.25%, which, is that going to hurt a little? Yes. Is it going to have a dramatic impact? Not really. I don't think it might impact like 1% of buy-to-let landlords. It's not that big of a deal. However, it is a sign to come. You know, it's been coming for a while now. Since the recession, we've had ridiculous interest rates. Yes, that is a word. Ridiculous interest rates that they can only really go one way, and that is up. It's not like you can go further down. You know, however, there have been some countries with negative interest rates. Oh, that would be sweet. So, what do you do about this? Well, what I'm doing about it is I'm not really worried about the next couple of years, but after that, I do predict a bit of an increase. So what I'm doing right now for probably the next 6 months is I'm going to be buying on 2-year fixed interest rates. And then when it comes up, I'm going to be benefiting from the refinance, because I think the capital values are still going to go up of property in the next couple of years. And then I'm going to refinance everything onto 5-year fix, just to mitigate the risk of increases in interest rates, which in my opinion are fairly inevitable in the grand scheme of things. So that's a bit of an overview of how I'm seeing the market right now. How do I think this will impact things? Do I think there's going to be another recession coming up? No, I don't. And I've seen some people's videos on here talking about it like it's dead fact. The problem with that, and if you're one of them, the problem with you is you will be right eventually, because the property cycle is around 18 years overall, give or take. There's going to be a recession at some point. And if you keep on going, there's going to be a boom. Guess what? I'm going to be right too. Do I think there's going to be an immediate impact in the next year of a recession? No. I don't think there's going to be a dramatic correction in prices. What I do think is that there will be a correction in demand. I think it's been a confusing time over the last couple of years. And what I think the impact's going to be is slowing down the prices. I don't think the people that can buy are going to be offering a lot less. I just think the slowdown of offers going in is going to be there. What this means for us going direct to vendor is that when people are looking to move quickly, I think there's going to be some great opportunities in pricing. Is this going to change the way that we should invest? No. This is why I focus so much on the return on capital employed, in the fact that I always say, and you've heard this many times, you don't wait to buy property, you buy property and wait, in the same way that timing the market is a fool's game. You just cannot do it. It's easy for all these fundamental and technical analysts going, oh, we could have predicted that. It's like, yeah, great. I can predict something that happened 10 years ago, mate. It's not that impressive. What moves did you make on those predictions? Funny enough, not a lot, but we could have. Yeah, we coulda, shoulda, woulda, mate. So don't try and time the market. It's all about time in the market that's going to get you winning. So don't change your philosophy. Don't feel pressured into buying something. For me, I'm looking for that 8 to 10% return on capital, and that is not changing whether the market's going like that, or whatever direction it's going in. Stick to the basic fundamentals of property and you can't get caught out. That's it for today's video. If you got value from this, let me know what you thought in the comments, and of course destroy the like button. And if you're new to the channel and you want to find out more about property investing and scaling your portfolio, then make sure to hit the subscribe button and the notification bell, and of course I will see you in the next video.